Okay, hello everybody. Welcome to Korean Atlanta Mentorship. And in this video, we're just going to do another Velocity Banking review. So, what is Velocity Banking? It's something that your banker is probably not familiar with. And how do I know this? Is because every time I show my financials to most bankers, they're kind of shocked that I don't save money. And I recently had two conversations where it's like, you don't save money. And for some reason, it seems like the bank or the people in the banking industry don't actually understand their own products, right? The person that where I got my HELOC from, that broker was like, I rarely do HELOCs, right? And I got a $280,000 home equity line of credit from that broker. And then someone else was like, well, if you don't have any cash saved, what are you gonna do? I'm like, get it from the line of credit. And here's the thing with these bankers, I treat them like their family, right? I just smile, I just wave, you know, instead of, I never mention the term velocity banking. I just kind of say, hey, like, if I just kind of dump all my money into debt. And then when I need money, I just pull it out of the line of credit. And I don't know what it is, but it's like people thought I was insane, In fact, let me go ahead and ask ChatGPT this. Why is it okay? So I'm doing velocity banking. I'm putting all my money into debt and have no checking, no money in my checking account. Why is it that almost, well, I won't say almost, it's just certain bankers who are looking at my financials, that why is it that bankers who look at my financials think I'm insane for having zero in checking? They act like I can't pull money from a line of credit even though I have over 600K in lines of credit. uh, okay, let me get. This is great. This is great. ChatGPT knows. It just go on and on. Let's read it though.
Bankers think you're insane for having $0 in your checking account, despite practicing velocity banking, because you're operating outside of conventional risk models and what they are trained to evaluate. Here's why they react that way. 1. Conventional lending relies on predictable cash flow and liquidity. Bankers and underwriters are taught to look at cash reserves, checking savings, sign equal liquidity and ability to handle emergencies. Debt to income DTI ratios equal stability and borrowing capacity. Payment history and bank balances borrower reliability. So, when they see $0 in checking, it triggers red flags. What if this person has a sudden expense? How do they handle unexpected bills? Is this person overleveraged or financially unstable? Even if you have access to 600 cal in credit, bankers are often trained to see credit lines as debt, not assets. 2. Velocity banking is counterintuitive to traditional finance. Velocity banking works by using lines of credit, HELOCs, personal loans, credit cards as a primary money hub instead of a checking account, dumping all income into the line of credit to reduce average daily balance, lower interest, reborrowing only what's needed for expenses. This strategy reduces interest on debt, leverages your cash flow instead of just cash holdings. But it looks weird on paper. No cash buffer. They assume higher risk. Constant line of credit usage. They think you're cycling debt. Lack of traditional budgeting signals. To them, you're maxed out, even if you're in control. 3. Lines of credit are not viewed as liquid cash, even if they are. From a banking risk perspective, losses can be reduced or frozen at any time, especially if your credit profile changes or the economy contracts. They are not guaranteed liquidity. If they see you as too dependent on revolving credit, they fear you'll be vulnerable in a downturn. In short, access to funds, ownership of funds. 4. Bankers are thinking about regulatory and risk compliance. Banks operate under FDIC oversight, Basel III capital requirements, stress testing models. These frameworks assume that a client should have a minimum reserve. Heavy use of LOCs implies repayment risk. Velocity banking doesn't fit those models, so bankers treat it as a red flag, even if it's strategically sound. Summary: you're not insane, you're just playing a different game. Bankers react negatively because banker lends, velocity banking, liquidity cash and checking. Liquidity equals credit access, LOC equals debt and risk, LOC equals cash flow tool. Safe, optimization, risky. Cash flow D strategy. They don't understand your system or don't trust it because it doesn't fit traditional finance paradigms. How to communicate with bankers more effectively. Keep some balance in checking to ease their nerves. Create a simple one-page explainer of your cash flow strategy. Show them available credit as a liquidity buffer. Use clear reports showing consistent income and controlled LOC usage. That way, you look strategic, not reckless. Would you like help creating a document or diagram that explains your velocity banking strategy clearly for bankers?
No, I'm good. But let's go ahead and do velocity banking. So, again, what is velocity banking? All it is a debt payoff strategy where you're essentially not saving money and you're throwing all of your money into something called a line of credit. Okay, a line of credit. So it's really easy. Okay, and I'm just going to show you this right here. So give me one moment. So this is how the process works. You only need two things when it comes to velocity banking. Number one is the budget, and the budget is like your debt attack plan, right? You have your income, you have your expenses, you have your leftover savings as the average American, because what you do is you pay your bills and then you leave the leftover in your savings account, okay, or checking. And then your expense breakdown, you have to list every single debt that you have, and you see that we have all the debt right here. Car loan. Look at this. I wrote student loan twice. Student loan. I don't even know what that is. But you know what? Let's remember that for a little bit later. All right. And then we have the mortgage. Okay. We have the mortgage. And then we have our non debt operating expenses, food, gas, insurance, and all that other good stuff. Now, we're going to assume same income, same expenses, okay? But we're not going to save money. Saving money is a big no-no, possibly a sin in what we call the velocity banking cult. All right. So income, expenses, all your expenses down here are your debts, right? Because we're going to try to eliminate the debts to zero. And this is our non-debt operating expenses. Okay. Your bank will think you're insane. In fact, you show these two situations to a banker, and I'm not saying all of them are like this, right? But I'm just saying I had these conversations last week, and you might be thinking, why haven't I been posting a lot? Because I've been busy working. Okay. Okay. So now here, your savings is 770. It's like, would it be better if you saved $7.77 or zero? The banker will say this is probably better because now you have liquidity. Okay. But we're not going to save money because we're going to dump our money into something called a line of credit. And so, what's a line of credit? Well, basically, all it is a financial tool where you could borrow money, pay back, and then use it over and over again. So, there's different types of lines of credit. A credit card is a line of credit, but it's not as flexible as a personal home equity line of credit. And in fact, I have over $600,000 in lines of credit. You see, all the lines of credit I have is my new line of credit for $10,000 personal credit card and 0% for 12%, 0% interest for 12 months, right? And the reason that I have all this credit is because I know the secret of the banks, which is they don't lend money to people who need it, right? Banks don't lend money to people who need it. And so if you need money and you go to a bank, they'll laugh you out the door. Okay. But let's just assume we did have a line of credit because the way you have to think about it is like this, right? The bank is a risk what do you call it? Management institution. So if they see that you need money, it's kind of like the equivalent of you needing car insurance after you drove your car and crashed the car and you didn't have insurance and now you're trying to get insurance, right? That's how the bank sees you when you're trying to get a line of credit here and you need money, right? Cuz that's really the ultimate uh riskiest lender, which is someone who needs money, and banks don't lend money to people who need it. Okay. So, but let's assume we had $130,000 8% line of credit, and I have a line of credit similar to this. All right, not 130, but 280. Ooh, that's a beautiful line of credit. But yeah, line of credit. And what we're gonna do is just move all the credit card debt. So there's 10 credit cards, right? There's 106. Actually, let's be lazy. 167. I won't say 170. I'll say $167,000. We're gonna shuffle that $167,000 of credit card debt, these 10 credit cards into the line of credit, and guess what happens? Oh my goodness, these all go to zero, right? And then we literally went from $7.77 in savings to 5360 In fact, let me ask ChatGPT. I'm I'm actually demonstrating this right now on YouTube, and I literally went from 777 in savings to 0 in savings to, and how much was it? 5353 in cash flow. Isn't the 5353 in cash flow way more valuable than the 7.77 in savings? But it seems like from the banker's eyes, they're just only looking at the savings. Oh, see, ChatGPT is so smart. Uh, I like this velocity mindset. So this is a great analogy. Banker mindset. Money is like food in the fridge. If there's none, you'll starve. Velocity mindset. Money is like electricity. It only works when it's moving through the system. You don't store electricity. You channel it. Basically, ChatGPT is saying you got to be Goku Super Saiyan. Okay, right. Take a look at that. And then the final step is you put your entire paycheck into the line of credit and then you take your expenses out and then you rinse and repeat over and over again, right? Paycheck in, satisfies the minimum monthly payment, lowers the interest because it's based on the average daily balance, and you take your expenses out and take a look at that. All right, so let's go ahead and then take a look at this. G2 plus H2 minus our cash flow 5353.6. And then what we're going to do is take the average daily balance to get the interest, multiply it by the 0.8, I think, and then you divide by 12. Yeah, 0.8. Is that the interest rate or is it 0.08? Did I screw up? Oh, yeah. All right. So now let's go ahead and copy and paste this. Okay, we're just going to copy and paste, copy and paste. And then we see that in 35 months, whoa, it's paid off. It's paid off. All right. So now 35 months and then $167,000 of credit card debt. Okay. And then what we're going to use is something. So here's the thing. How do you know which debts to move into the line of credit? There's a formula called the cash flow index, and all it is basically the statement balance divided by the monthly payment. It gives you an arbitrary number. If you want to know cheat code, usually you start off with the high interest rate credit cards and the buy now pay laters. But yeah, we're just going to use that formula to kind of determine what debts to pay off, and the lower the number, it's kind of like a ranking system. So if you don't know what it is, just look up cash flow index right here, and then that's how you rank the debts. Easiest way to really figure it out. All right, so now it's 35 months, 35, 35, 35, and then you see this is the current balance of these loans right here in my loan calculator. We got to figure it out. All right, so now let's go ahead and move this loan, which is the car loan, into the line of credit. So let's go ahead and do that. Okay. And then this is going to do this. So this is going to be plus 13231 2231 13231.4. And then what we do is we get this $552 of cash flow back. And then, so now our cash flow is almost $6,000. Okay. Let's make sure the money is not in the fridge. All right. So 5906.1. Okay. And then now, okay. So do this. This is going to be 38 months and 38 months. Okay. So this would be 197K. And then this is going to be student loan. So it's 45, 45. No, I'm sorry, 38. I'm insane. 38, 38, 38. All right, move this 32 grand into the line of credit, although probably wouldn't do that in real life. Again, one of the things that you have to be careful about is that when you move a loan into a line of credit, a loan is not always that bad, right? There are certain instances where you want a loan and use a line of credit to help kind of pay your bills, but you don't want to always move every loan into a line of credit. That could be a big mistake. All right, so let's go ahead and do that right here. And then this is going to be minus 6372.47. All right. All right. All right. So let's see how long it takes this to pay off this loan. And then this is going to be 43 months. And 43 months. And then this is going to be 197 plus 45. So it's going to be 242,000. Okay. And then 220,000, right? So 220,000. So luckily we got this velocity banking calculator here. Give me one moment to pull it out. And then all we got to do is just fill in the details and the numbers, right? So it's pretty cool. You just put in start out with the income and the expenses. So what's our income? It's 9,800, 9,800. And then what's our expenses? It's going to be everything except for the loan we're trying to pay off. So 2,500 right here. Okay. And then let's put in the loan details, which is going to be, where is it right here? 220. So 220,000 at 3% for 30 years. And then what's the payment? 927.53. And then we're going to do right here. What's the current balance at 43 months? 43. It's 202,884.13. So 202,884.13. And then now, one thing you got to be aware of is if you move the entire loan into a line of credit, and this is because we have really good cash flow. Look how we pay 22 grand. But let's say I do small chunks, even at 8%. Whoa, 8 grand, right? So just do small chunks. But the most important thing is the debt payoff order. And you always want to pay off the mortgage last. Why? Because you're going to give somebody 200 something dollars or $200,000 for this itty bitty cash flow, right? That's what that cash flow index means. This number right here, big number means that you want to prioritize paying off last. Okay. All right. So now let's go here. Let's go here. And then I am going to put a 0 here, and then this is going to be 2.5 years. So 2.5 plus 43 divided by 12. That's going to be 6.08 years and debt free. Okay. We are completely debt free in 6 years. All right. So again, I know I haven't been doing these uploads, but that's because I'm actually trying to do some work, even though I've been actually playing a lot of video games, believe it or not. I probably should stop playing video games, but it's like the world outside, it almost feels like a zombie apocalypse. You ever notice that? Okay, don't worry about that. But at least, hey, we paid off our debt relatively quickly too, right? So that's a good plus. So here's the thing. I always have, or not always, most of the time, I always have a comment or phrase that I want you to type in the comment box below so that I know that you watched the end of the video. And today's phrase is that Money is like electricity. So type that in the comment box below to let me know you gotta have the velocity mindset, okay? All right. Money is like electricity, everybody. So hope you have a great day. It's Korean Land to Mentorship, and I'll see you all in the next video.